South Korea did not lose 40% of its economy. The economy is growing. The factories are running. Exports are up. And yet, in about 40 days, roughly $2 trillion of Korean stock market wealth simply stopped existing. Nobody bombed anything. No bank ran out of cash. The machines that make most of the world's memory chips did not pause for a single second. Everything physical is exactly where it was. So what precisely disappeared? Here is the awkward part. The number in that title is real. It is also attached to the wrong noun. Korea's stock market fell about 40%. Korea's economy did not. In fact, this year, Korea's growth forecasts were revised upward, not down, which means the gap between those two facts is where the actual story lives. Because Korea just ran a very public, very expensive experiment on a question most people never think to ask. What is a stock market actually measuring? Not the schoolbook answer, the real one. To understand a 40% fall, you first have to understand an absurd rise. Rewind to January 2026. Korea's main index, the KOSPI, sat somewhere around 5,000 points. Then artificial intelligence ate the world's memory supply. Every large AI model has the same unglamorous bottleneck. Not intelligence, bandwidth. The chips have to be fed data faster than ordinary memory can deliver it, and the fix is a specialized component called high bandwidth memory. Stacked layers of memory, wired vertically, sitting as close to the processor as physics allows. Almost nobody on Earth can make it well. Two of the companies that can are Korean, so the money came, and it came from everywhere. Foreign funds, domestic funds, pension money, and then, crucially, ordinary people with an app on their phone. By May, the index had pushed past 7,000. SK Hynix, a company most people outside Asia could not name, crossed a $1 trillion valuation. By late June, the index touched above 9,000, a gain of roughly 90% in under 6 months. For context, that is a decade of normal stock market returns delivered in a single Korean spring, and it felt, at the time, entirely justified. That is the thing about a melt-up. It is never built on nonsense. It is built on something true, stretched. Taxi drivers were discussing memory yields. Nothing about that sentence is a good sign. This is the first thing that broke, and almost nobody noticed while it was happening. The KOSPI is supposed to represent hundreds of Korean companies, shipbuilders, cosmetics, steel, car makers, banks. But by mid-2026, a large majority of the index's entire gain came from just two names, Samsung Electronics and SK Hynix. Estimates put their share of the rally around 70%, and that estimate deserves a healthy pinch of salt. The direction, though, is not in doubt. So when people said Korea's market was up 90%, what they mostly meant was two chip companies were up an enormous amount, and everything else was politely along for the ride. The index had quietly stopped being a thermometer for a country. It had become a thermometer taped to one very hot machine in one room, in one building. That is not a scandal. It is not fraud. Nobody planned it. It is just what happens when one industry grows faster than everything around it, and it means that anyone watching the index thought they were watching Korea. They were watching two factories. Here is the mechanism that turns a correction into a collapse. A very large share of the buying was done with borrowed money. In Korea, it is called margin trading, and it works exactly as unsexy as it sounds. You put down some of your own cash, your broker lends you the rest, and you buy more shares than you could actually afford. Margin debt in Korea hit record levels through the first half of 2026. The reported figures vary a lot between outlets, so treat any single number with suspicion, but every source agrees on the shape. Records repeatedly, concentrated in the same two chip stocks. Now the arithmetic. Suppose you borrow so that you control 3 times your own money. If the price rises 10%, you make 30. Wonderful. If the price falls 33%, your money is gone, not reduced. Gone. And here is the part that matters most, the part that turns a bad week into a broken market. At that moment, you do not get to decide whether to sell. Your broker sells for you. Millions of people, all with the same 2 stocks, all with the same trigger price. Leverage does not just amplify losses, it removes the possibility of patience. The trigger did not come from Korea. On the 28th of July, reports landed that China had begun mass-producing its own deep ultraviolet chip-making equipment. Treat that carefully. An announcement about capability is not the same as proven output at scale, and the hardest part of chip making is not building one machine. It is building millions of working chips with it, reliably, cheaply, for years. Serious analysts disagree sharply about how close China actually is, but markets do not price certainty. They price stories about the future, and the story that arrived was simple enough to fit in a headline. Maybe Korea's monopoly on the most valuable component in artificial intelligence has an expiry date. Then the next day, SK Hynix reported its results. Record revenue. Record operating profit. The best quarter in the company's history. Reported figures came in around 79 trillion won of revenue against expectations closer to 84. So, the best quarter ever, and a miss. Its shares fell double digits. And if a record-breaking quarter can do that to a stock, then the price was never really about the quarter. Quick pause, and the bot is going to insist. It has been building a live map of this cascade, all video, and it will not run without power. Around here, that power comes from subscribers. If this has been clear so far, hit subscribe, and the map lights up. The duck is not helping. The duck has never helped. Right? Doors. What follows is not really a decision by anybody. It is a machine running. Prices fall, so accounts hit their trigger levels. Brokers sell those accounts automatically. That selling pushes prices lower, which trips the next set of accounts, which triggers more automatic selling. On the 29th of July, the KOSPI fell as much as 12.5% during the day, dropping below 5,300 for the first time in almost 6 months. It hit a market-wide circuit breaker, an automatic pause, and then it did something the Korean market had never done before. It hit 1 on 2 consecutive days. Across just 2 sessions, about 864 trillion won of market value was gone. At 6 in the evening, Korea's finance minister called an emergency meeting with the central bank governor and the 2 top financial regulators. For the month of July, the index fell about 23%, the largest monthly drop in its recorded history. From the June peak, the total decline was around 40%. There is your title. It took 40 days, and it was not the economy. It is worth sitting with what this actually was on the ground. Every one of those automatic sales had a person attached to it. Not a fund, not an institution. Ordinary Koreans, many of them young, many of them buying 2 of the most respected companies in their own country, which is not a reckless thing to believe in. They were not wrong about the chips. Korea makes extraordinary chips. They were wrong about one thing only. They borrowed money, which meant they needed to be right on a schedule. Conviction is free. Borrowed conviction has a deadline. Korea's government opened debt counseling lines. Not a bailout, not a rescue fund, phone lines staffed by people for other people who could not sleep. That detail tells you more about this crash than any index level does. Now, the honest part. There is a serious argument that this crash is the mistake, not the rally. It goes like this. Nothing that actually generates money broke. The chip demand is real, contracted, and enormous. The earnings that triggered the panic were, in absolute terms, the best in the company's history. Deep ultraviolet equipment, the kind China reportedly built, is not the most advanced tool in the industry. And closing the gap on high-end memory involves years of yield engineering, not one announcement. Meanwhile, Korea's official growth forecasts for 2026 were raised from 2% to 3%, and at least one major bank went to 4%. On this reading, what fell was not a business. It was a pile of margin loans. And the two things got confused because they were sitting in the same place. Prices can fall for purely mechanical reasons and be wrong. That argument might be entirely correct. Yet here is the uncomfortable truth. It might also be exactly what people said in every bubble ever recorded, because the fundamentals always look fine right up until they do not. Both of those can be true at once. That is what makes this genuinely hard. And anyone selling you certainty in either direction is selling you something. So back to the first question. What disappeared? Not chips, not factories, not skill. What disappeared was agreement about a price, and the borrowed money that had been propping that agreement up. A stock market is not a measurement of a country. It is a continuous, public, slightly hysterical vote on the future. And crucially, votes bought with debt count exactly the same as votes bought with savings, right up until the debt is called in. Here is the strange coda. Korean crypto trading had already collapsed, down roughly 90% from its peak. Largely because that money had walked next door into stocks. Then, stocks fell 40%. The same enthusiasm, the same borrowed conviction, wearing a different outfit. Korea did not have a crypto problem or a chip problem. It had a leverage problem, and leverage is very good at changing its clothes. Which is the one thing worth taking away from all of this. The asset almost never matters as much as the terms of. Korea's factories will very likely be fine. The chips are real, the demand is real, and the country that fell 40% on paper also had its growth forecast raised this year. Both things happened. Both are true. That is not a contradiction. It is a lesson about which numbers describe the world and which numbers describe our opinions about the world. So, one question, and answer it in 5 words or fewer. If you had money in there, would you have sold? First honest answer. Gets pinned, and one pinned answer this week gets sent a small gold coin from us, an actual one, in the post. Thanks for watching. Go look at something physical.